You've been watching condo prices go down month after month, and you're thinking that your position is getting worse. That makes sense. That's a total normal read of what you're seeing and what you're hearing. But here's the thing, that's kind of the wrong number. The number that actually tells you whether this move works is the gap between what you'll sell for and what you need to buy. And right now, that gap is moving differently than most people think that it is. If you're timing this decision based on where you think condo prices are headed, there's a real chance that you're waiting for a signal that never actually gives you the answer that you need. So what I did was pull the last 3 spring months, March, April, and May, and compare them against the same period last year. Over 400 transactions across both markets. And I'm going to break them all down through 5 signals that feed into that gap, because understanding the gap is what turns market data into something that you can actually make a decision with. Now, before I get started, I should say that all condo data that I'm about to use is technically for Mount Pleasant West, which you can see right here, and it is bordered by Yonge on the west side, Mount Pleasant on the east side, Beltline across the bottom, and this is Keewatin across the top. And this area basically captures pretty much all the condo sales that are happening for Yonge and Eglinton. Now, all the East York numbers that I reference in this video are for 3-bedroom semi-detached properties in E1, E2, and E3, which would cover pretty much all of the area that you and I would know as East York. The first signal that I want to talk about is inventory. It's how much supply each market is carrying relative to the demand. So here are the months of inventory for, again, March, April, and May of 2025, which are the blue lines, and 2026, which are the red bars. And as you can see very consistently, the months of inventory is dropping year over year. Now, that is a good thing when we see numbers dropping for months of inventory, because, well, it's a good thing for sellers. It's not necessarily the best thing for buyers, but it has been predominantly a buyer's market for a number of years now in the condo market. So I think sellers are kind of looking for a little bit more of a turnaround. This video is supposed to be meant for people who are looking to sell a condo and buy into a house. So that's what I mean when I say that these numbers are actually improving. So you can see that all the months of inventory are dropping kind of year over year, although from month to month, they're relatively volatile. So you can see that in March, the months of inventory was 4.19. In April, it actually hit 3.7. We're going to talk about that in a little bit. And then for the month of May, which just finished, we had 5.41. Now for East York semis, you can see that there's a little bit of volatility. So, from 2025 to 2026, for March and April, the months of inventory actually went up very slightly, but then for May, year over year, it went way down. But generally speaking, we've got very, very low numbers of months of inventory for 3-bed semi-detached in East York. And what this means is predominantly a very strong seller's market, which probably comes as no surprise to you, kind of hearing me say that. So Yonge and Eglinton condos are sitting at 5.41 months of inventory in May, and the East York semis are at 1.25 months. That's 4.3 times more supply pressure on the condo side. And I'll say that is big. When I track the monthly numbers for families making exactly this kind of move, that kind of inventory gap tells you pretty much everything that you need to know about your negotiation position before you even start looking. Now, I'll be honest, I actually pulled the April data twice because I wanted to make sure that I was reading it correctly. The Yonge and Eglinton condos dropped to 3.7 months of inventory for that 1 month. And aside from, like notoriously low inventory months like January and February, that briefly crossed into seller's market territory for the first time since November of 2024. But unfortunately, it didn't hold. So basically, here's what you've got. You're selling into what seems like maybe a recovering but still fairly soft market, and you're buying into a consistent seller's market. In May, buyers had over 5 months of condo inventory to choose from, but on the semi side in East York, 5 weeks. If you've been watching general condo prices and feeling like your position is getting worse, this is exactly why the gap matters more than either price on its own. That kind of inventory imbalance kind of already baked into your negotiation position on both sides of this move. Now, the April signal was real. It just didn't hold. Condos pulled back to balance conditions in May, while the semi-market stayed fairly tight. Two completely different market dynamics that are running at the same time, which makes this challenging. Now, inventory tells you about leverage, but timing tells you how long you actually have to use that leverage. The second signal is days on market, how quickly properties are actually selling once they hit the market. So here are the days on market for condos at Yonge and Eglinton. You'll see there's not really a lot of rhyme and reason as to what's going on. Things sold 3 days faster in March, but then took 2 days longer in April, and then 12 days faster in May. So a lot of volatility, not really any trends that we can discern from those numbers, unfortunately. Now, here's an interesting chart for East York. If we talked about there being volatility with Yonge and Egg condos and that kind of stuff, here, no matter the month, no matter the year, 8 days, the median days on market for East York, no matter what month, no matter what year. Extremely consistent, no change whatsoever. So Yonge and Egg condos had a median of 16 days in May, and East York semis were on for 8 days. And that's a 2-to-1 timing gap at best. Actually it's bigger for some of those other months that we talked about. But here's what I think is really telling. Across 6 data points, 2 full spring seasons, East York semis hit 8 days every single time, like clockwork. But condos, they ranged from 16 to 29 days. So they're not just slower, but they're also unpredictable. Your selling window is twice as long and less reliable than your buying window. And when a good semi hits the market in East York, and I'm talking about a really good semi, you're typically looking at needing to see it within 48 hours, let's say, to get ahead of a potential bully offer. That's the coordination challenge that nobody really talks about. And this is where just watching your condo price kind of misses the whole picture. The gap isn't just about the money, it's about managing 2 completely different timelines at the same time. 8 days on market, 6 data points, 2 years. That's not a trend, that's a market structure. The semi-market has a very consistent absorption pattern that the condo market just doesn't have right now, unfortunately. But timing and inventory together, they determine something even more important: your actual negotiation power. The third signal is sales to new listing ratio. What percentage of properties listed actually sell? So here's that cluster chart showing the sales to new listing ratio for Yonge and Egg condos. And again, consistent improvement from 1 year to the next, comparing those 3 spring months. So we've got a sales new listing ratio in 2025 of March going from 29 up to 33%, in 2026 21% all the way up to 41% in April, and 23 to 32%. So the idea is that the sales to new listing ratio is a comparison of the number of sales and the number of new listings. So it's kind of like a supply and demand comparison between the two, and it's expressed as a percentage. 40 to 60% is typically observed as a balanced market. Anything less than 40% would be a buyer's market, and anything more than 60% would be a seller's market. So you can see in 2025 that very consistently the Yonge and Egg condo market was in very much a buyer's market. Now, for the most part, in 2026, it's still in a buyer's market, but not as strongly as a buyer's market. And it even in April, very briefly, broke into the very early stages of a balanced market, which is a positive sign for condo sellers at Yonge and Eglinton. Now, when you look at the sales for Yonge and Eglinton, again, stayed relatively consistent. So this wouldn't necessarily be the explanation for the improvement in the market dynamics for Yonge and Egg. You know, you've got 33 compared to 31 in March, 29 compared to 37 in April, definitely is a big jump. But then 1 month later in May, we saw a year-over-year decline from 33 to 30. So some volatility, not a lot of consistency there. But what explains it would be the number of new listings. You can see from 2025 to 2026, we had very consistent and significant drop-offs in the number of new listings, from 115 to 94, from 136 to 90, and from 142 to 95. So when you keep, generally speaking, the same number of sales, but the number of new listings drops significantly, the math just works out that those percentages for sales to new listing ratio are going to get much higher. So things didn't necessarily improve because of the sale side of things, but they improved because there was less competition, generally speaking, overall in the market. Is that a sign that sellers were maybe giving up and not wanting to list their condos because things have been so dire over the past couple of years? Maybe. I'm speculating by maybe guessing that. But regardless, people who have decided to sell their condos now, generally speaking, are seeing slightly better conditions in the market. These are the sales to new listing ratios. Slight decline in March, very slight decline in April, but then a big jump up in May. So again, not necessarily any trends that we can gather. May was probably a little bit of an anomaly. If we take a look at the sales that happened in East York, then we can start to see a little bit of the pattern. There were drop-offs in the number of sales, which is why we would have seen a decline in the sales to new listing ratio, or certainly partial explanation, and then an increase in the number of sales in the month of May from 2025 to 2026. So that's part of the explanation. And if we take a look at the number of new listings, you'll see a decline in the number of new listings, which would have improved the numbers. So that means that for March and April, the decline in sales was greater, had a greater impact than the decline in new listings in terms of whether that sales to new listing ratio gets improved or not. And then we see a really big drop off in the number of new listings from May of 2025 to May of 2026. And so with an increase in sales and a big drop off in new listings, that's where we get that big improvement in the sales to new listing ratio for the month of May. So as you saw in May, Yonge and Egg condos came in at a sales to new listing ratio of 32%. East York semis hit 56%. The raw numbers, 95 condo new listings to 30 sales, 97 new semi listings, 54 sales. So basically the same supply, but very different demand on either side. And for every 3 condos that got listed, 1 sells. And for every 2 semis that get listed, more than 1 sells. And that's kind of the whole story in basically 2 numbers. And here's the thing. For families in your situation, when you understand the gap, this stops being a stressful data point. It becomes actionable. You're not just moving from one property to another, you're switching from a fairly weak negotiation position into a strong one. Now, I'm not saying that these are temporary conditions, but this is what it looks like when 2 markets are operating under completely different supply-demand fundamentals, and those things affect pricing. So the fourth signal is year-over-year price direction, not just where prices are, but where they're headed. Now I have to take a second to explain something briefly. When we're talking about Yonge and Eglinton condo sales on a month-to-month basis, we're looking at basically 30-ish sales for all condos of all types: 1-bedrooms, studios, 2 bedrooms, etc. Places with parking, without parking, whatever. Both the averages and the medians are not going to be a great representation, changing from month to month and year over year, just because of the mix or the skew of the different property types that are, making up that total number of sales. So what I did is I used the Toronto Real Estate Board Home Price Index benchmark price for Yonge and Eglinton condos, just to try and eliminate as much of that weird skewing as much as possible. Now for East York semis, even though I'm looking at a specific subset, 3-bedroom semi-detached properties, but I was able to use median prices without any issue because there were, let's call it roughly 40 plus sales to use for that specific type. So the median is not going to be kind of wavered as much as possible. And we're not comparing 2 bedrooms with 4 bedrooms or anything like that. So there's a lot more consistency in that number. So speaking of which, here are the benchmark prices for Yonge and Eglinton. And you can see very consistent trend that the benchmark is down, and down relatively significantly in a couple of years, but down nonetheless from 2025 to 2026. So here's the median pricing for East York, and you can see nothing terribly significant. March down around kind of 1.6%, basically no change in April year over year. May down, let's call it 4%. But for the most part, you're looking at pretty consistently mid to high 1.2s, maybe 1.3. May, bit of an anomaly. I wouldn't necessarily count on that staying consistent from here on out. So Yonge and Egg condo benchmark is down from May 2025 to May 2026, 2.9%, okay, year over year, to about $610,000. The East York semi-median is down anywhere from nothing to 1.6% to 4%, depending on which month we're talking about. So there's definitely some volatility there, but the idea is that both markets are moving at different rates. But generally speaking, it seems like the Yonge and Eglinton condo market is improving from last year because the price declines are slowing down, if that makes any sense. And East York semi prices seem fairly stable. And what that means for your specific gap is what we're building towards right now. So this, in my experience, is where a lot of families get stuck. They're watching individual price movements instead of thinking about how these two markets are moving relative to each other. And the price direction matters, but relative price direction matters more, in my opinion. Looking at either benchmark on its own doesn't tell you what you need to know. It tells you what happened, not what you can do about it. And that brings us to the number that actually determines whether this move makes sense. Before we get to that final number, I track all 5 of these signals for every month for families making exactly this kind of transition. The gap between having the data and knowing what to do with it, in my experience, this is where families in exactly this kind of situation get stuck. You have done the research, you're watching the numbers, but you're still not sure what those numbers actually mean for your specific move. So I've put together a complete monthly market report. It's area specific with breakdowns. It's got transaction cost calculators, timing frameworks, the stuff that helps you turn this data into an actual move strategy. You'll find it in the link in the description below. The 5th signal, and this is kind of the one that matters the most, is the all-in cash gap, the actual capital that you need to make this move happen. So based on just May medians, the raw price gap is $604,800. Add $81,000 to $84,000 in transaction costs, so like land transfer tax, legal fees, realtor commissions, moving, staging costs, those kinds of things. Your all-in capital requirement is $686,000 to $689,000. That is a lot of capital. Now, you don't need that $686,000 in cash, but what you do need is you need to know exactly where those dollars are coming from. And here's where it gets a little bit complicated. That gap actually narrowed by about $32,000 in May compared to May of 2025, but it widened in March and April by $38,500 and $34,700 respectively. So this is not necessarily a clean story. It's a fairly volatile one. The people I see successfully make this move, what they have in common is that they started tracking whether they could actually execute on the gap when the other 4 signals that I've talked about line up. So if you add $81,000, let's call it, to whatever gap number you're looking at right now, that's the real all-in capital requirement. And in my experience, most people don't build that in upfront. You've probably heard that in a soft condo market, which is what we're in right now, you should sell first. Know your number, make clean offers, no conditions. That's the conventional wisdom. And I get why that makes sense on the surface. I used to tout that almost 100% of the time quite a while ago. But I would say that it's actually kind of backwards for this specific market. Selling first could end up costing you more than if you bought the house first. And most agents, including myself as of not too long ago, won't tell you that because honestly, it's a lot safer to say to sell first in a soft market. The full breakdown on why the conventional wisdom breaks down in these kinds of market conditions and exactly how to sequence your move to save that $30,000, that's what I get into in this next video right here. Plus, the complete gap analysis framework is also waiting for you in the monthly report, and you can find that link in the description below.